class, let's discuss some accounting and bookkeeping terminology.
Okay, so GAAP, Generally Accepted Accounting Principles, are the rules-based standards that govern financial accounting in the U.S. and must be followed precisely for accurate reporting.
All right, so bookkeeping accounts are essentially the backbone of financial records, classifying every transaction into assets, liabilities, equity, revenues, or expenses.
Okay, so a chart of accounts is simply a list of every account in the general ledger, organized by assets, liabilities, equity, revenue, and expenses.
Okay, everyone, write this down. An asset is anything tangible or intangible that holds value and can be converted into cash.
So pay attention, class. Liabilities are defined as probable future sacrifices of economic benefits arising from present obligations. Owner's equity is the amount of money invested by the owners plus retained earnings, minus any withdrawals. It represents the net worth of the business. Revenue, simply put, is the total income generated by a company's sales of goods or services before expenses are deducted.
All right, focus.
Business expenses are the necessary costs you incur to operate your business. This is crucial for determining your taxable income, so pay attention. Pay attention. The accounting equation states that assets must always equal liabilities plus owner's equity. It's the basis for all modern accounting. Simply put, the double entry system requires that every financial transaction is recorded as both a debit and a credit. This ensures your balance sheet always balances out.
Debits and credits are used to increase and decrease an account's balance.
All right, so a business transaction is simply an agreement between two or more parties to exchange goods, services, or financial assets in exchange for payment. Business source documents are essential for recording transactions. These include things like invoices and bank statements, providing evidence for all financial activities. Bookkeeping journals are your initial chronological records of financial transactions. You list your debits and credits here before posting them to the ledger. A general ledger is the core accounting record. It holds every financial transaction, organized by account, and forms the backbone of the financial statements. Look, the balance sheet summarizes your assets, liabilities, and equity. Assets must equal liabilities plus equity. It's fundamental, so type this down now. Simply put, the income statement measures a company's financial performance over a specific period, focusing on revenue minus expenses to equal net income.
Pay attention. Profit is revenue minus expenses. If you don't get this right, your business fails. It's that simple. A business loss results when a business's expenses exceed or are greater than a business's revenues.